Ladies and gentlemen, welcome back to the Capital Flows podcast. In today's session, we are going to cover and dig deeper into the idea of the credit cycle that we are in, how that connects to central banks, and how all of these different factors that I've been laying out end. And what I will say at the forefront of this breakdown is that if you have not been following all of the research on either the Substack or YouTube channel or Twitter or wherever you are, if you're very new, what I will say is, number one, all of the research, videos, links, whatever it might be, are always laid out on the Substack. And I am always breaking down the different ideas there. If there are any changes to the views that I have, they will be published on the Substack. And so you always want to go there as your first resource to understand all of the different changes or material or things like that for everything that I'm putting out. Number two is that on the Substack is an entire list of educational resources that I will cover at the end, and I'll break down a little bit more. Those are meant to be there as a resource for you so that you can continue to learn and grow with whatever your place is in markets or the economy or running a business or anything like that. You actually have the ability to have all of the resources to spend time trying to figure out all these different flows around interest rates yourself so that they can connect to you and you're able to develop the core competency that you have. When we think about how all of those different things come together, credit cycles are typically periods of time where you have significant injections of liquidity, and especially you have mistakes and errors by central banks. And that is one of the things that we are going to cover in today's presentation. And the main idea that I want you to take away from everything is that everything is about interest rates and the currency right now, because all of the debt in the system is concentrated on the sovereign balance sheet. That is key. When you have a lot of the debt or the majority of the debt concentrated on the sovereign balance sheet, that shifts how interest rates impact markets and the economy and everything else. And I'm going to break that down for you. So, where are we going to start? I'm going to start big picture with the debt to GDP chart. And all this shows the amount of debt in the system versus GDP. And we do that because you want to see, not just on an outright basis, how much you have in terms of debt in the system, but also relative to GDP. It would be the same thing as if I looked at the amount of debt that you took out every month, whether that's $1,000 or $100 or $10,000. That doesn't really mean anything unless it's relative to the amount of money that you're making. And if the amount of money that you're making is always increasing, then I need to look at, okay, what is your debt to income ratio for that month? In a very similar way, the debt to GDP chart is showing the same thing. This chart specifically is public debt to GDP, which just means what is the amount of government debt that we have in the system versus GDP? We're currently at 120%, which is a pretty high level historically. And then what is the deficit as a percentage of GDP? And that is sitting around 6% right now. And the one thing I will say about the deficit right here is that we're in a period of time where the government has a ton of options to pull levers that can change how they're functioning in the economic system. For example, we went to a deficit greater than 15% during COVID right here, which was, a massive change. And then even, after that time, we have gone to, 10% deficit to GDP during the GFC, and it would not be shocking to see a move back down to those levels. If that took place, that would cause a lot more resilience and growth in the system and additional inflation that would likely hit interest rates and begin to, really change a lot of the flows that we're seeing in markets. So the key thing to remember is that there are no rules about how much the deficit can or can't be. You see a lot of narratives around out here about the, current political climate, trying to reduce government spending or anything like that. Not happening. It's still taking place until they really see and feel the constraint of the amount of spending and debt that they have, which we don't see that on an investable time horizon. Until that happens, they're going to continue spending. And so when we think about what is funding that spending, the U.S. has a lot of levers to pull. Here is just a chart from the Treasury QRA, and all it is showing is the weighted average maturity of marketable debt outstanding. In other words, if we took all the U.S. Treasury debt, all the debt that the U.S. Treasury issues to be able to fund the U.S. government, what maturity is that? Is it all in short-term bills? Is it all in long-term bonds? What is that? And that's been a topic of conversation, because if you begin to have a lot more weakness in the long end, a lot of people will talk about how that begins to create weakness in the long end, and it becomes more difficult to issue debt in the long end. And when you look at this chart, the key thing to note is that during 2020, we had the weighted average maturity of marketable debt outstanding decrease. In other words, what the Treasury did during that time is that issued a lot of bills, which is just short-term debt, to be able to fund what was taking place. This could continue taking place. The Treasury could issue a ton of bills and bring us back down to the historical trend line and not have any problem with that, except maybe the debt ceiling, which Congress will keep pushing as they have in the past. And so when you have a period of time like this, where people are talking about the risks to the system or the risks to U.S. debt, you have to remember the U.S. Treasury has a lot of levers that they can pull. They can decrease the amount of, the weighted average maturity of debt outstanding, and the market will always take in short-term, T-bills. The market will always take that capital in, because, you basically can always just take that in how the liquidity transmission mechanism works. And so that is an important thing to remember, because when people are talking about how government spending or whatever it might be is, bringing us to, some ultimate issue, the amount of levers that the U.S. government can pull, whether that is in increasing the deficit, they could still do that. And increasing debt to GDP, they could still do that and push it up to 140% and bring the weighted average maturity of debt outstanding even lower. They can do all those things without an issue. Maybe it's going to cause some, headlines and things like that, but they can do it. And so the key thing to compare between the public system is that household debt to GDP is actually falling, and it's at 67%. This is a key chart because since the financial crisis, there has been a deleveraging in the household sector. And if you didn't watch the video I did earlier on the agents in the system and how to break them down and how to think about them, how to think about households, banks, and things like that, that will be linked below, and it's the most recent video that I posted on Twitter and YouTube. Everywhere else you can go find it, but I will link it below. The important thing to understand here is that when you have the household sector decreasing the amount of debt on their balance sheet, why is that important? It is important because when the household sector is really leveraged, the higher interest rates can begin to impact them more. Higher interest rates don't really impact the U.S. government spending. If interest rates go up, the U.S. government just keeps spending and they pay a higher debt service cost. Whereas the household sector, they have the possibility of actually defaulting and the unemployment rate going up and things like that. So the divergence that we're seeing is all of the debt is concentrated in the public sector. And the household sector is actually, it doesn't mean we can't see deleveraging, doesn't mean we can't see defaults, but when we think about where is all the debt, it is not in the household balance sheet. And sure, you can pull up idiosyncratic things here or there. You can complain about data or whatever it might be. But at the end of the day, when we think about it on a big picture basis, on a macro basis, the U.S. consumer remains really strong. And the other key thing here is, well, what is the debt service ratio for consumers? Which means how much are they paying of their income to all of these different sources of debt? And we are still below the period that we saw in the 2010s and definitely below the periods in the GFC. So you can begin to see that when people begin to talk about how there's going to be a second great financial crisis or something like that, it's really not based on the data. They'll pull up idiosyncratic charts here or there, and they'll extrapolate small data points to the whole, but they'll never show you the full picture like we're going through right here. And here's the reason why, is because anyone who's a risk taker in markets, they don't have the luxury of having views that are not connected to the actual changes in markets. And so when we look at this is actually clearly reflected in the price action of stocks and bonds, and I will go over that in a moment. And so the other thing here is just personal bankruptcies. Again, same story. Really low on a structural basis. They're lower than, the 2010s period and significantly lower than the entire GFC period and not even ticking up at all. And so that's an important thing to note, that we know that the debt is concentrated on the public balance sheet, the sovereign balance sheet, and that the household and consumer, they're not showing, massive signs of stress right now. Doesn't mean we can't have a little bit of an unwind or change or anything like that. But it does mean that this idea of a second GFC or something like that, or the economic and credit cycle playing out like the GFC, there's not really a precedent or evidence for that. Now, there is some important risks to note that are different than the GFC that we're going to go over in a minute. But the key thing to note is that the consumer is strong and not over leveraged. But the entire problem you have in the system right now is that everyone is expecting basically deflation and recession. Here is just a count of all of the news articles across the major platforms and financial media news outlets talking about deflation or recession. And you will notice that since 2020, what has taken place? You have had a massive, massive rise in people talking about deflation and recession. And that's been at an elevated level since 2020. That's why when people talk about how much, markets have changed since 2020, a lot of it is people selling, fear, uncertainty, and just all of that danger that takes place, and they extrapolate that. But think about it. They're talking about deflation and recession, and what has taken place during that entire time? Functionally the opposite. We've continued every single time the market prices recession in the stock or bond market. We unwind that positioning with so much aggression that people realize they made a mistake, and they realize that they need to be long equities and really short bonds. And so the financial media continues to focus on this theme. And also you have economists with an expectation of a recession around 35%. This is, very similar to all these different things we're talking about, where you have the 2010s, not a big deal happening. You have your COVID spike. And then since 2021, 2022, 2023, 2024, you have recession probabilities, above 20% the entire time, and nominal GDP is expanding every single quarter. And so you continue to see all of the economic data points and markets move in one direction, showing a resilient nominal GDP and strength in the economy. But then you have this entire divergence between the media, economists, everyone, because they don't understand the playbook of higher nominal GDP because they've anchored to COVID and the GFC. And so that really creates a lot of opportunity if you understand how this credit cycle works, which is actually very different than the run up to the GFC. And I'll explain that in a couple charts moving forward. So, main idea, going back to the first idea that I started with, everything is about interest rate risk and the currency. Why? Because all of the debt is concentrated on the sovereign balance sheet. This just means that when you have changes in interest rates, a lot of assets in markets and then also in the economy become leveraged to that because the majority of the debt in the system is U.S. Treasuries. And so a lot more is becoming about duration risk, and there's a higher probability of inflation risk as we move through the next 3 to 4 months, because think about it. If the consumer isn't over leveraged, then the higher interest rates are not transmitting through as well, which means there's not going to be a lot of, layoffs and defaults that cause inflation to come down. So all these different flows are connected. So the interest rate and the currencies, how do these come together and how do we think about them? So the Federal Reserve and the Treasury work in tandem under the constraints to manage both interest rates, the sovereign income statement, the sovereign balance sheet, and the currency. What does that mean? It means they're managing interest rates, and they're also managing the sovereign income statement, which just means all the money that's coming in and out of the U.S. government, and then also the sovereign balance sheet. What's all the assets and liabilities that the government has? Mainly liabilities. And then also the currency. They're not going to really talk about the currency as much, Bessent or Powell, because they are trying to stray away from, some type of currency strategy, because that is going to inject a lot of different issues into the market. But they are very well aware of the currency and how it is functioning as we move through different periods of time. And so the economy, in connection with this, is less sensitive to interest rates. And part of the reason for this is that the economy is less and less sensitive to the changes in interest rates because the amount of debt in the S&P 500 has gone off a cliff, and it's come down a lot. So here is just total debt to equity and then total debt to total assets. And you can tell that in the run up to the GFC, or these more elevated levels of debt, then since that time you've seen deleveraging very similar to the household sector I showed you earlier. There is more debt on the corporate balance sheet, but in terms of the amount of debt, it's much lower in terms of, just relative to, again, assets or equity. And that is one of the reasons why, you have all these massive Mag 7 names that are flush with cash, and they have an incredibly strong balance sheet because they are just printing so much money every single quarter, and that decreases their default risk exponentially. That is different. Well, that in itself means that they're less sensitive to interest rates, right? That is fundamentally different than the Russell, which has more debt on its balance sheet, right? There is more debt in those companies. And that's why the Russell, or one of the reasons why, the Russell is more cyclically sensitive. It's also just because they're small caps. And, when you're a small cap, typically, you have, just more, regional or whatever it might be factors that can impact you, and you have less of a diversified base on something. There's some other reasons for it, but, broadly speaking, small caps a lot of times have more sensitivity to changes in economic growth and things like that. And so you can tell that the Russell has, debt has come down, especially, since 2020, but the level is still elevated and a bit higher than the S&P. And this directly ties into the changes we have seen. Notice how interest rates here moved up for a prolonged period of time over the last 3 to 4 years. But then after the inflationary cycle was over, what happened? The S&P moved back up and made an all-time high, and continue to trend up, and we keep making all-time highs here, even as interest rates are at these higher levels. Notice the difference that interest rates rising and the Russell falling, again, very similar to the S&P, but once interest rates begin to rise again, that begins to cause the Russell to underperform, and especially over here, and we're still below all-time highs. We couldn't break out here, couldn't break out here yet. In my view, we are going to move higher, but just notice that on a long-term basis, the Russell does have more debt, right? And that is a reflection of that debt differential in the charts previously. Now, how does all of this connect to the melt-up scenario, the changes that we are seeing in growth and inflation and things like that? What we have seen is that the Federal Reserve is now in a stance that is too accommodative for financial markets. And we are still seeing interest rates at high, and you are seeing the Russell actually rally as interest rates are moving up, which just means what? That capital is moving out the risk curve, and the higher interest rates are not being restrictive enough for it. That's key, because if interest rates are moving up and not dragging on high-risk sectors like the Russell or, again, sectors with more debt, that just shows how much credit, growth, and money are in the underlying system supporting flows in small caps and in those higher-risk sectors. And this brings us back to, 2022, in my view, because everyone now thinks that higher interest rates are bearish for equities because of this 2022, precedent, which is important to think about. There is likely going to be a moment where the higher interest rates begin to cause equities to crack. However, in the same way that we don't want to anchor our biases to 2008, we don't want to over-anchor our biases to 2020. It's important to know we want to have that in the back of our mind, but we don't want to overweight it in a way that is unrealistic. And so the way that I want to break that down is by going over a couple charts from 2000 and 2008, actually. What you will notice, especially in 2000, is here's the S&P 500, and then here's the 10-year interest rate. The 10-year interest rate and the S&P 500 rallied for years together, which just means stocks went up and bonds went down for years in one of the largest, rallies in financial history. That, is an indication that the underlying liquidity and growth in the system far outpaced the degree to which interest rates rose. And then you finally began to have shifts up here. We're not going to go into the actual shifts that happen, why and how that has parallels to today. We're not really there yet and seeing the signals, but understanding how these types of shifts work are absolutely critical. And so it would be very easy to see interest rates move up right now and equities move up at the same time. But what's happening is people, because they're anchoring to 2022, they think that things like crypto or gold or the S&P 500 can't move up at the same time as interest rates move up. And this is a great example of how these types of credit cycles play out and how they work. And very similar dynamic into 2008, right? And so the other chart that I want to show is of the Russell as well during this period of time, and you see something very similar. In 2000, when you had that rally, a lot of it was connected to, obviously, the tech stocks. So the Russell had a lot less exposure, but you can see the same thing. The Russell moving in lockstep with interest rates right here. Same thing right here. And then, again, during the 2000, in the run-up to 2008, you had a lot more momentum in small caps, cyclicals, financials, real estate, obviously, and those sectors. And there is, a very massive precedent for interest rates to move up with equities moving up at the same time. So how does the Fed fit into this, and why is that important right now? The Fed has, since the 2024 now, has been holding rates in a range. Here's just the 12-month rate, and that is a reflection of, okay, where does the market think rates are going to be in 12 months? And then you have one-year inflation swaps here in orange. What we saw in 2024 was the Fed being way too accommodative and way too aggressive in their rate cuts in 2024. They front-loaded everything with a 50 basis point cut, which was a mistake in my view, and the market viewed it as a mistake because bonds sold off right after that. Just massive sell-off in bonds. And since that period of time where the Fed has done cuts, inflation expectations have only rallied. The problem with that is when you have inflation expectations rally, what else is rallying during this period of time? You also have the Russell rallying, especially more recently. You have the Russell rallying and inflation rallying. And what is the Fed doing? They're basically pausing, and they're in this entire stance of 50 versus 25 bips this year, and they're kicking out rate cuts to 2026. That stance is one of being neutral. Maybe you're going to pull back and not do a cut in September or something like that, but overall, on a bigger picture basis, that's neutral and too accommodative for the type of move that we're seeing. If the Russell is moving up and you see high-risk sectors moving up and interest rates are moving up at the same time, it just shows how much strength there is in the system. And the last thing that the Fed needs to be doing is pausing, especially as inflation swaps are rallying. So that's the type of risk that we're in right now. And you will notice that interest rates, 10-year interest rates are at cycle highs right now. I mean, we're almost at levels and above levels that we were at pre-GFC. Right here in 2006, 2007, we're basically at the same levels, right? Almost at 5%. And what is taking place right here? Credit spreads are at cycle lows right now. And until we see a momentum shift with an informational change to bring rates down and credit spreads up, the regime that we're in shows that the higher interest rates, those are not beginning to put downward pressure on growth to cause an unwind in the labor market or in any of the other major sectors. And so that is going to be an important relationship to watch, because until that takes place, the main risk is inflation and the Fed, because you can have long end rates blow out to the upside, and that is going to begin to, we'll see how much that moves in lockstep with equities, but right now we still see capital moving out the risk curve. What does all that mean? The implication is that stocks remain skewed to the upside on a cyclical basis, and interest rates remain skewed to the upside on a cyclical basis as well. Until we see changes, those are the skews that we have based on the data. And the other charts that I want to share, really pulling all of these different moving parts together, are the low quality sectors right here, which continue to rally, and then the Goldman Sachs most shorted index right here, which shows all the stocks that are shorted the most. In other words, which, when that is moving up, you can basically have a reasonable idea that short positioning is getting squeezed out. And that happens a lot of times during melt-ups. And so, when I approach these types of, periods of time, I know that there's going to be a moment in the future when the higher interest rates and when changes in liquidity begin to create downside risk for equities. And I know that in the interim, I want to be long equities and also long some inflation risk, which just means long some commodities. If you just look at something like the Bloomberg Commodity Index, I talked about it in the last video, that's really key. And also long assets that are able to benefit from the excess liquidity in the system, things like Bitcoin. The problem with this, though, is that eventually, if you have higher interest rates that begin to drag on the system, and you also have inflation begin to come back and a weaker dollar, and you have all these things combining at the same time, and they don't actually create a recession in the economy because the U.S. consumer remains, not over-leveraged, then it would be very easy to see the underlying nominal growth and inflation in the underlying economy accelerate, and that can pull down asset prices, especially if they're at a high valuation. And that would pull capital back from the risk curve. You would likely see commodities outperform. And in that period of time, you want to be short stocks and short bonds. And that would be a little bit more similar to 2022. We're not there yet. The fact that we saw the dollar sell off earlier this year with equities, that was a key signal in my mind about the type of period of time we're in. No one's really talking about that. They're just focused on the fact that we're rallying right now, which is great. But what are going to be the signals for the next regime shift? And all of those different types of things are going to be important to watch. So if we pull everything together, all of the research for these ideas is laid out on the Substack at capitalflowsresearch.com. All the videos are also on the YouTube channel, and you can see the most recent videos there. And then linked below, so wherever you're watching this on Twitter or YouTube or whatever it is, I put all the charts that I shared in this deck on the Substack. So you can go to the Substack and you can download any of the charts that you want or save them or do whatever you want with them. And you can go through those and reference them or just keep them. I would throw them into ChatGPT and ask questions about them. I think that's a great avenue, especially if you're learning a lot of these things and trying to connect it to your specific focus in markets. And then all the educational primers are right here. And then finally, below in the Substack, I will be linking the playbooks on how to develop a macro thesis, how to understand the drivers of the S&P 500, and also how to understand the drivers of Bitcoin. So everything's laid out there. I'll be continuing to put out research on the Substack and continuing to write some additional pieces that break down how these changes are likely to develop as we move into FOMC, because that will be critical for the Fed stance. If they decide to shift their stance, that could begin to put a top in risk assets. If they continue to pause, that can begin to further fuel the upside that we are seeing. So, with that, I will see you guys soon.